Good evening, everybody. Fix my camera angle. Strange. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. And I am back to talk about our stock market investment strategy utilizing closed-end funds. That's a mouthful. So, to get the normal disclaimers out of the way, this is an unedited video, as you've seen. I mean, I've had to adjust my camera. I think I've said maybe twice. And yeah, at any rate. So who knows what all you'll hear in the background as I film these in my house. Now, I'm not a financial advisor. I am a financial strategist. I don't speak like the herd, and I walk in limited company, and sometimes I walk alone. So I'll give you a brief update of things, and then I'm going to intro this a little bit different than normal, and then we'll get into the list. So I've it's Christmas break. Thankfully, school is out for another week. I still have some pretty important stuff to do around the house, and getting us ready for the new year and just life in general. Um, but I've been writing. It's been very good. Uh, what started out as just, I don't want to say words on a page. Um, I wrote this dividend book or strategy book, kind of like an all-encompassing, like got everything on paper that I could think of with the goal to go back and then break it down into chapters later. Currently, it's a six-chapter book, short in the grand scheme of things, but at the same time packed with information. So making progress. One book down. This book hopefully will end soon. Then I go to a scholarship book, and then it's really going to involve me making some hard decisions about how to piece it all together, how to put it all together, how to get it out there, and all the other business side of things. So, uh, for the strategy session this week, not much has changed. Um, it really hasn't. the The overall targets are still there. Um, but I guess let me say it this way. So instead of the regular intro and the talking points, all that stuff, let me say it this way. And I'm going to paraphrase my email to my group this week. So New New Year's overall looms. It's a stilted market week in the sense that it's not going to be a complete financial week. But there are a lot of people who feel the weight of the new year, or at least they feel weighed down by the current year, and they're approaching next year with fear as it is, or there's anxiety in regards to how they're looking at next year, which we'll get into that at the end. For the rest of this year, which is not that many days, investors are hoping for the Santa Claus rally. But even without it, the S&P is going to wrap 2025 with a pretty significant gains, and it'll carry those into 2026. And on the closed-end fund world, we're seeing the same thing. But more importantly, in all markets, we are setting up for beefing up the already raging bond bull with rate cuts coming, right? With a new Fed chair looming, with rate cuts coming, everything should do better or perform better with a rate cut. But bonds in the bonds proxy market should accelerate. They should take off. So if we're staged for another bond bull or a continuation of the bond bull, then why has the bond market dipped a little bit? And the easiest answer is not the best answer. The easiest answer is I don't know. But I can extrapolate, or I can, I, if I, no, I don't know how to say this. Um, if I infer some things, this is what I think is going on. It comes down to the herd. and where they're used to searching for value. If you look at the CNN Fear and Greed Index, it's currently in greed and it's been ramping back up into greed. But we're not seeing that in the bond market right now. The bond market is down. The herd sees the easy AI shiny coin and they're greedily pumping money or cash into that sector of the market. And to do that, they're either using new money, right? GDP is up, but to do that, they're either using new money or they're selling anything they can find with that fear of missing out mentality. Like, I have to do this right now, so I'm just going to sell this other stuff. They're they are chasing the shiny object at all costs. And they're hoping for growth, but trading consistent income for that potential high. And it's been in more than one Indiana Jones movie, but in Indiana Jones Search for the Lost Ark or Raiders of the Lost Ark, you've got Indiana Jones and his, I want to say, Egyptian friend watching the other crew dig for the Ark, and they have this epiphany that they're digging in the wrong place. And that's really what the herd's doing. They're digging in the wrong place, or at least they're digging with the wrong tools. So selling consistent income, hoping for shiny growth, isn't a long term strategy or a strategy built on income acceleration. That strategy requires you to sell your portfolio for parts while you're driving it versus building an income vehicle that pays and accelerates while you use it. It's a very different mindset. You and I, and I don't know your reasons for investing, but at the same time, you and I are operating on a bigger picture vision, and we've oriented our investing strategy around that. Or maybe we've attuned our investing strategy to that vision, like we're sailing in that direction. The herd looks for reflections. They look for isolated incidents along the way, and we're looking for sustained growth and income along the way. That buy Apple for 10% growth, that's the reflection mentality. Buy Apple for buy Apple for 10% growth in 5 years. Well, that's 2% growth a year, far less than inflation, and Apple pays a shitty dividend, far less than inflation. So your desire to buy Apple now, knowing that it's going to be worth more 5 years from now, isn't really that great of a financial decision because the worth of your value your value has become worth space less in the course of that 5 years. And depending on the actual numbers of inflation, it might actually be worthless in 5 years. And that's not to say Apple's a worthless company. Apple's a great company. But searching for reflections and isolated incidents aren't growing your wealth. They're not growing your income. And they're certainly not accelerating your income along the journey. They're just leaving you behind. And you and I, we do things differently. So it doesn't make sense. But I'm not here to make sense or even apologize for the herd. I am tasked with making the best decisions for me and my family. So while the herd sells parts for gas, I will gladly profit off their loss. And the bond market has dipped, so that sounds like a great buy. And of course, yes, end-to-end energy and technology beyond the big guys, those are still on the radar, but I don't know if you'll find a better deal than the bond and bond proxy market right now. You can make a great case for all three, but bonds are the most downtrodden and are also poised for significant growth in the coming rate cut environment. So if bonds are making money now, they'll make more money with lower rates. Everybody will do better with lower rates, right? And that's where that shiny coin gets even shinier, or that reflection gets even more eye drawing because lower rates, better value, right? But the bond market should explode. So and explode in a good meaning. So What does that mean for us? Well, let's look at the overall master list and we can deep dive the breakout sort for the week. So let me get to that page. Share. Interesting. Why is it not sharing? Close that. That's what I want. Share. So I went through the list this week. There were three new funds. That's the one fund in yellow that made the list. There's three new funds. There's a lot of significant discounts, but we need to really cull the list. So all the discounts are significant. So we cull by when the dividend pays. So let's see. Australia is not where I'm looking. USA, Deox is great. It's great before volatility. It's not great in volatility. And Madison is still too much of portfolio in a can for me. So that leaves this list. Now let's be extremely choosy or maybe extremely selective and really try to pick 9% or greater dividends. And in doing that, all of this drops off. Now, NML, KYN on my end of things are currently priced higher than our average buy-in cost. Not looking to increase that, even if it's just a few cents. RFI and RFI rarely goes on discount. So when it does, it's interesting. And HFRO remains the largest discount, but they've done a lot of work to trim that discount down. It used to be at 60%. Still, it at 47% off. That's like paying 53 cents on the dollar for every share invested. So you could make a case, or maybe I could make a case for HFRO and RFI. But if we're going to be hyper selective, they still have to get dropped off the list. So that leaves us with this list. Now, RFI, RQI, and RLTY are all owned by Cohen and Steers. It's really the same exact portfolio. It's just you want to justify, but yes, it's discounted, it's significant, it's close to 15 bucks a share. If you're going to buy, or if I'm going to buy Cohen and Steers, then I'd much rather pay 11 than 15. So let's look at this. PDT, not PIMCO. Let's see. PIMCO fund, PDX at 21, even with the discount, that is not on my radar. ZTR is a dollar cost average move. All right. So between RLTY, right, with the 9% dividend versus RFI with an almost 9% dividend, me, I would rather pay cheaper for pretty much the same exact portfolio. And HFRO will leave on the list simply because it's got the greatest discount. So that leaves DOY, which is bonds. NBXG is 5G tech. CIF is the bond roller coaster. I don't know enough about First Trust. Still, I'm not an Aberdeen fan. Global Utility Fund, Bond Proxy, PIMCO comes down to the dividend on my end of things. So you've got 11, 11, and almost 15, but you're going to pay $17, almost $18 for it. So That's like 10 off. That's about a percent off. I'm not paying like all of these funds for the most part are structured differently, but at the same time, if I can buy it cheaper, I'm going to buy it cheaper, unless there's good reason not to. Um, let's see. So PDI we'll get rid of. These two I've targeted for a while. They'll stay. Let's see. HGLB we already own. It's got a nice discount, but it's higher than our buy-in value. Nuveen. So US to international bonds. It all depends upon your overall bond strategy. If for my end of things, I'm looking for US investment, inflation's going down, the value of the dollar going up. That makes me want to invest in the US and focus on the US. You could argue for international for the flip side. With a stronger US dollar, international bonds might get cheaper. Uh, so maybe that is a good international play right now, but it's not on my watch list. So that would be the differentiation between those two. Let's see. Same thing for this. If I'm going to prioritize US investment, that drops off. FSSL is the newly created FS fund. And as tempting as it is, there's just not enough data. Like it's a month old. The closed end fund space of the market, the investors are extremely leery about buying new funds. Um, and I did a ton of reading today on how they organize the company. It's very interesting, but at the same time, there's just not enough data. PIMCO is the cheaper of the funds. Um, let's see. We already own bond fund. We own three Nuveen municipal bond funds. We own several overall bond funds. I'm interested in adding a PIMCO fund if the price is right, but I'm not going to add just anything. FSCO will stay on the list. Anything CLO right now is still downtrodden. It's tempting because it is a dogged corner of the market, but there's still rampant fear in the CLO market space, and that makes me leery. Like I love OXLC. I dislike the reverse stock buyback they did. That yes did pull back some shares or buy back some shares, but at the same time they jacked the price. It used to be consistent pricing. Since they jacked the price based on available shares, it's harder to price in and justify me spending $14 when I could buy something else for 6. So let's see. That gets rid of all of those things. Hicks doesn't beat the market. DMO, EIC is back to the CLO market space. And we're left with this list. So bond proxy, real estate, bonds, shareholder activists, bonds, business development, bonds, bonds, utility, bond proxy, powerhouse. It's a powerhouse blue chip fund. So technology, AI, but it's a cyclical thing. And the limitation is that if you buy it now, you're not going to get a dividend until March. NBXG is 5G tech. DLY is still bonds. Real estate and bond proxy, real estate and bond proxy. So you can make a case for all of them because they all fit the radar list. Like you could find every one of these companies currently on the radar or on the target list for sure. The final pick is going to come down to a couple of things. One, your overall ability to buy. So whatever you have to invest. Two, what's already in your portfolio. Three, where you see the most value. And then four, your overall long-term projections. So the herd itself is pumping money into tech and AI, and that would be the blue chip market space. But even outside of that, we're on the forefront of the next AI revolution. And the AI goal, like the Golden Dome that President Trump wants to create, where we make the U.S. the AI, the AI capital of the world. We're at the forefront of that. So you could successfully argue for anything U.S. stock and blue chip just on those premises. On rate cuts, they should do better. Like everything should do better. But if I'm going to be extremely choosy with my money, and as tempting as the AI and the blue chip front of things is, then I would cut those out and I would hyper focus on bonds and bonds proxies, which all of these are. So then what does it come down to? I think it still comes down to value and what you want to spend. On my end of things, what would I buy if it was me? It's all tempting. Buying HFRO cheap with a with a still a massive discount is tempting. RFI cheap any day of the week is always tempting. DLY, we own the sister fund. DLY's been on my target list for a while. Meggy, it, worldwide energy would not be as tempting as if it was all US energy. It's a term fund. It's great it's great right now when the existing discount exceeds the 1 year discount, but it's still a tempting fund. PDO has been on my watch list for a while. PHK is cheaper. Yes, you can buy more of it. Yes, but that difference they're similar in dividend, really, because it's about three times the value, right? But it's a pretty, I don't want to say lateral move. It's a pretty equal split just on face value. So without getting digging into the individual portfolios, it's a pretty like I'm going to pay three times as much for this and get about three times the dividend, but that one just edges out the dividend by a little, the overall yield by a little bit. So it's pretty much the same thing. I always like these two when I can buy them together. And IGR is not a historically significant uh, it's not a significant discount in the sense that it exceeds the metric double the historical greater than the 5 year. It's that it's finally at discounted value, or it's finally at a discount, one, because it's generally not, and two, on average buy-in, it's about $1 less than what we currently pay, or it's $1 less than our current average buy-in price, and that makes it tempting as well. And it also fits the bond proxy strategy. But on my end of things, to be specific, I think it's 1206. That makes it hard to pick up my normal set of things because I like buying in sets. I like buying in 50s and hundreds, but really lately it's been 100 shares, 100 shares, 200 shares, 300 shares. And I like buying these two together. So it's really hard to pick up 100 of both. Um, I can't pick up 100 of PDO or MEGI or DLY. I can pick up 200 right outright of HFRO. That would push this. And yes, this is our actual portfolio. That would push that up to 12. That would raise our buy price a little bit. Um, RFI, yeah, 11, 12. So to buy RFI a little bit less than where it was, it's kind of tempting, honestly. If I could, I would pick up 100 shares of both of those easy, easy. And honestly, 100 shares of a new fund is a great way to start. And I don't know why Bing decided to show an ad right now. It's a great way to start, but I don't know when the next time I would add another 100 shares is. Like the week to week evaluations change. So it's a little more tempting to pick up, and I couldn't buy 100 shares actually in those. It's tempting to pick up 100 shares here because it would leave me with a really, like, I get it, like about $100 left. But it would still leave me some small fledgling basic balance to continue carrying forward. So is there a best decision? I don't know. I think all of these are great decisions. It really depends on how it fits into your portfolio. On my end of things, I don't plan on buying tomorrow. Um, I'll quite honestly, I'll sleep on it and I'll see. I would much rather get the remainder of my dividends for this month and then buy something in January. But we'll see how that goes. But at least for now, that's my list for the week. Or at least, let me say this, that's my list for the week. For now, that's my current outlook. Not to buy tomorrow, to wait till my dividends get paid for the end of December, and then to make some sort of purchase in January. On the Roth end of things, if you've got a Roth, you've got really until you pay your taxes for 2026 to add into your Roth for 2025. But on my end of things, I transferred the Roth from Webull to Fidelity. I noticed that in doing so, so it cost me $75 to transfer, $75 and a cent to transfer the fund from Webull to Fidelity. And we put in like a fledgling amount of money while it was still at Webull. So Fidelity doesn't track the money that we've already added to the Roth for the year. So according to Fidelity, I have really the full 7 grand to add for the year for 2025. So that's a little bit off. Two, I paid the transfer fee, which came out of my available free cash in the account. So I had to repay the transfer fee. That's the premise of the Roth. Like money came out for the transfer. I had to put money back in to cover the transfer, but it actually counted the $75 towards my contributions for the year. So that's kind of interesting. Uh, and ideally, on a Roth, yes, you're adding money consistently every month. You're buying every month, or you're stockpiling to make a buy every couple months, and you're investing throughout the year. I completely understand that. It's been a crazy financial year, uh, crazy financial year. So on my end of things, I need to decide sooner than later how I'm going to add 7 grand to the Roth just to have that and resolve 2025 without any kind of headache or potential headache. And yeah, not that I think Fidelity is going to be like, I'll throw a wrench in the plan and not let you add money for 2025 as we move into 2026. But at the same time, I'd rather avoid that headache if I can. Uh, yeah. So if I add money to the Roth and get the end of year dividends when we buy in January, then yeah, we'll probably be making more moves in the Roth on purchase, and then buying some stuff in the cash brokerage in January. So this is my list. We'll see how it plays out in my strategy and when we buy. On your end of things, you've got to do the same. And I'm sorry if I kind of waffle my way through it and talk it through it with you, but I do I want to share my thoughts and share my strategy, even if that means I wander about while I do it. So last week, I wrapped up my video with most things people don't talk about on videos and when I talked about Christmas stuff. This week I'm going to do a little bit differently as well. With New Year's looming, I don't know the percentage, but the vast majority of people make New Year's resolutions. And me personally, I hate that stuff because most people, when they make resolutions, throw ideas out like you're throwing spitballs at a wall, or blowing spitballs at a wall. You're throwing everything up there and hoping something sticks. And that's just not the right way to go about it. Much like investing, much like we treat our finances, if you want significant change, you have to install a plan that you can stick with and be consistent about, can stick with and be disciplined about. So if you're going to plan a New Year's resolution of anything, then don't just be, I'm going to do this, right? And make a list and that be end of it. Think about what needs to change in your life. Think about what might be beneficial for you to do and see if you can figure out a systematic way to get there. Like when my full-time job status changed, I started working out because I finally had the time to work out. And I put together a plan that I could do every day. And after doing that for 4 years, are there days I miss? Yes. Do things come up? Yes. And I actually enjoy the workout. So I feel the loss of not working out. Um, but the not the repetitious, but the systematic approach, the disciplined activity of making sure I work out helps me process. It helps me decompress. It helps me feel better. I've lost weight. I've gained muscle mass. Like there are benefits the longer you're in it. Most people make New Year's resolutions and they abandon the system within a month. So if you're going to work out to lose weight, then don't just say you're going to work out to lose weight. Like put the entire system in, and it doesn't have to be perfect. It's not going to be perfect day one or week one or month one, but put a system in that you can follow and that you can consistently be held accountable to every day and make that happen. And then when that's easy, then work on your diet. And when that's easy, do something else. Like don't just get stuck in the same resolution in the sense that you're working out to lose weight, but there's going to be more stuff with that. Like eventually you're going to work out to lose weight and you're going to drop body fat and gain muscle and you're not going to lose weight anymore. So what now? So the same way we systematically approach our finances and investments, whatever your purpose, cause, New Year's resolution is going to end up being, apply the same mentality. Put in something you can do, make reachable goals, give yourself a checklist, make the entire plan. Like if you're going to work out and still eat like shit, guess what? Nothing's going to change, right? If you're going to work out and not eat any protein, if you're not going to address your vitamin deficiencies, if you're not going to switch from drinking carbonated poison to water, like there's so many more things than just working out. But you get so tunnel vision focused and I have to work out. And then you make it so hard that you can't hold yourself accountable to it. So you just give up. So the same effort you put into your finances and the vision and the scheme and the scope and the organization and the systemology and the strategy, all of those things together help hold you accountable to the system you've created and the system you still need to build. So if you're going to take anything on for the new year, apply the same thing. And if you can't organize your thoughts, here's the value of AI. If you cannot organize your thoughts and you have no one to talk with, write every write everything down and then type it back out because it'll help you organize your thoughts better. And then just spit it into AI and say, help me make sense of this and make a plan, and it'll do it for you. But it's a dangerous crutch because if you're trusting it to get everything right and think for you, It's not helpful. You need to think through your problem. Talk with somebody else. See who else has done what you want to do and been successful at it, and see if they'll give you advice. And if you want a systematic approach, you want AI to organize your thoughts, ask it to organize your thoughts and help you process so that you can think about it, reorganize, reprocess, script it out. And if you need to, then spit it back to AI too and bounce it back that way. That's actually how I write a book. If I let AI do all the talking, it will write a book for me. And I'm sure a lot of people do it that way. But if I wanted AI to write my book for me, I would have just asked it to write my books, gosh, 8 months ago. I want to do the work, just like you want to do the work on your finances, right? You just want the same drive and passion with anything new you undertake. So I'm going to step off my bully pulpit. I'm going to step off my soapbox and hopefully not lecture you anymore today about resolutions. On the closed-end fund forefront, the book is almost done, and it's been fun and challenging to write, and it covers some of what I do on my videos, but also covers a lot more. So I'll get that information to you as soon as I have it, or at least as soon as I've got it in a accessible place. Currently, it's just a draft manuscript, so we'll get to that at some point. And in the meantime, I wish you a great end of 2025. Whatever you've got for New Year's Eve, even if you're just staying at home and enjoying your family and being quiet, enjoy New Year's Eve. Have fun, be safe, come back in one piece, right? Live to see another day. And whatever you have for the new year, yes, one, I wish you health, happiness, and wealth. But at the same time, I hope you grow personally and spiritually this year. And I hope it starts now before 1/1. I hope it starts now. And I hope it continues forth. And I hope you can easily see your progress as you go throughout the year. But much like working out, sometimes you don't see the results. Sometimes you don't feel the results for the first 4 to 6 weeks. So if you're doing something new and you're not seeing the results, you can by all means call a friend, right? But you can also kind of check your temperature, check your status in about a month. And if you're willing to show up every day and you're willing to put in the work every day, then those small changes will eventually add up and you'll start to see results in about 4 to 6 weeks. So whatever it is you got for the week, whatever it is you have for the new year, I wish you well. Hope you have a great New Year's Eve, and I will see you all on another video. Bye-bye. End my video. Always hard to find the mouse. All right, bye-bye.